Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from the OECD's Pillar 2 to Japan's latest corporate tax developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. Check out PwC's Policy on Demand news platform that provides in-depth insights and analysis on tax policy developments. Policy on Demand is now available for free at policyondemand.pwc.com. On this week's episode of Cross-Border Tax Talks, we're recording from the Hotel Lobby Policy on Demand studio at PwC's International Tax Conference in Dana Point, California, where I'm excited to be joined by Shin Yamaguchi. Shin is a Tokyo-based international tax partner where he leads PwC's inbound tax practice for Japan. Shin is a graduate of Deep Springs College, Stanford, has a law degree from Yale, and an LLM from NYU. He writes broadly on matters ranging from geopolitics, ESG, and tax policy. Shin, welcome to the podcast. It's great to finally have you on.
Thanks for having me, Doug.
Well, so Shin, I was there and I was in Tokyo in December of 2022. It is early 2023. We spent a lot of time talking about Pillar 2, and
yes.
I'm really excited to have you on because there's been some proposed legislation.
Lots happened over the past couple of months.
A lot has happened.
I gave you the heads up, by the way.
You did, and
take credit for that.
a lot of discussion now around the world and involvement. But before we dive into Pillar 2, wanted to get your experiences, or to get your reflection on your experiences. You started your career, an amazing academic background, spent 10 years advising multinationals here in the US. You spent the last 6 years of your career working in Japan. And how did your experiences as a US advisor impact your experiences advising Japanese multinationals?
Sure. I think something that is near and dear to our hearts as tax advisors is the role of the tax function. And as you well know, Doug, in the US, tax is very close to business. How do you advise on supply chain, now ESG, transformation, business transformation, et cetera. And I think that in Japan, perhaps tax function is still growing, and it's in the process of transforming itself, being closer to the business side. Now, of course, we too have issues around supply chain with the geopolitical situation in Japan, US and China, or ESG, which Japanese companies are very much committed to. And so how can tax become more relevant and have more interactive discussions with the business, as well as the fact that Pillar 2, becoming such a significant undertaking, has a higher profile within the business, and how can we use this as a launching pad to reassess the global tax operations of Japanese multinationals? That's something that perhaps I can leverage my experience in the US as we go forward over the next couple of years.
Yeah, I think one of the things that that I've seen as I've talked with a number of folks from outside the US, even on this podcast, that what a huge undertaking Pillar 2 is going to be, and we're going to come back to that because I do want to get your reflections on how Japanese multinationals may be positioned. And the point is interesting that the tax departments, and of course there's exceptions to all these generalities, but that the US, oftentimes for US MNCs, the tax practices just have a lot more depth. Arguably maybe because of just the historic complexity associated with some of the US rules that's differentiated some of the Japanese multinationals as well as other multinationals across the globe. All right, so let's dive into Pillar 2.
Sure.
And before we get into some of the mechanics and what we've seen from the legislation, I think it would be helpful for the listeners to understand what is the Japanese legislative process, because this really is going to dictate kind of when rules get introduced, when they get finalized, and then we'll kind of go through some of the mechanics and effective dates. But just how does the legislative process work in Japan, and where are we from a Pillar 2 perspective?
Sure. So tax legislation in Japan can only be enacted through the annual tax reform. And the annual tax reform is the proposal comes out in December, and then the draft legislation comes out in February, and then the bill is passed in March. So that's the annual schedule, if you will. Now you have taxpayers and industry associations providing input over the summer. Ministries will take that and discuss with the governing party, and the governing party, Liberal Democratic Party, ultimately comes out with the outline proposal in December. This year is slightly different. The Pillar 2 legislation, specifically the IIR, is in line with the globe rule. So there's not as much discussion, if you will, between taxpayers and the the government in that regard. The government is taking what the OECD has and implementing it, and the taxpayers had other related questions around the model rules, but it was widely expected because it's a one-shot proposal that it would be the IR would be implemented in the 2023 tax reform as it has been.
So it's really it's 1 billion. Effectively, in Japan, you get one shot a year. I said
correct.
The policymakers get one shot a year to implement these rules.
That's right.
And then is there also, how would additional guidance be incorporated? Is there enforcement orders, I think, or how does that work with respect to providing potentially some additional color? You know, from a U.S. perspective, we obviously have regulations. Is there something similar or analogous in Japan?
And if you look at this year's legislation as well, with respect to the IIR, the important information, such as who are the taxpayers, how much tax will be paid, that information has to be codified. So that will be in the law itself, but other supplementary information can be issued via the enforcement orders, which will be come out over the following few months.
And is there any requirement for like the enforcement orders to come out with a certain amount of time? The reason I ask is because we've recently received some additional administrative guidance, and then the OECD has also said that there will be additional administrative guidance issued throughout the rest of the 2023 calendar year. So from a Japanese perspective, particularly if there are some substantive changes, how would that get incorporated potentially into Japanese law? Is it possible that that could all come through in enforcement orders, or we may have to wait till next year, next March? How does that work?
That would, to the extent it's substantive, we would have to wait until next December. Interestingly, the draft legislation came out a day after the administrative guidance was issued. So we should expect, and in fact, to the extent that the administrative guidance needed to be incorporated, some of it was in the draft legislation as well.
Okay, so some of the information from the administrative guidance, presumably Japanese policymakers were engaging with the OECD to understand, to make sure that they were consistent. Yeah. And then it will be interesting, just as we kind of track this process around the world, particularly the different legislative process, and as we continue to get guidance, the concern that I have for taxpayers is just how different are some of these rules based on the time of enactment.
Exactly.
And certain policy decisions that need to be made.
I mean, from a timing perspective, we were waiting as long as we could for the OECD guidance to come out, but generally the tax reform proposals come out in early December. This year it came out December 16th. We were waiting for some of the information, but ultimately the safe harbor guidance came out thereafter. Temporary safe harbor rules are cross-referenced in the draft legislation. So we are kind of working together with the OECD and incorporating as much as we can in 2023 tax reform. Anything additional should be expected to come out in the 2024 tax reform.
All right, so maybe before we dive into the rules, how many Japanese kind of companies-ish are in scope? So, the 750 million euro threshold, there are a lot of multinationals in Japan, and so any idea just kind of approximately how many companies may be in scope for these rules?
Yeah, we expect that over 800 Japanese multinationals will be in scope, so quite a number, and each of them has hundreds of subsidiaries all over the world, right. So it is quite a number of entities that are in scope. All right, subject to the safe harbor, of course.
Yeah, and
we can talk about later.
We'll get to the safe harbor. So tell me a little bit about the income inclusion rule. What came out in the legislation?
Sure.
So sort of income inclusion rule and the undertax payment, undertax profit rules.
So this year's 2023 tax reform, the income inclusion rule will be implemented, and it's very much in line with the global rules, obviously. And as to the QDMTT and UTPR, the Japanese government has indicated that we should expect the QDMTT and UTPR to be introduced, but the government has said that the timing is unclear. It's still under consideration. I think much of it is around where will other countries stand, and so just kind of wait and see. And at the earliest, it will be introduced in the 2024 tax reform, effective 2025. So there would be a 1-year delay minimum.
And because it's not in this year, because the UTPR and the QDMTT are not in this year's budget, like it won't be in for 2024. The soonest it could potentially be in would be for 2025.
Correct. And keep in mind the QDMTT, whether it's somewhat unlikely that a Japanese subsidiary would have a less than 15% jurisdictional ETR, just given how our tax system is, so unlike the U.S., for example.
Right. Well, I'm going to challenge that here in a few, but wanted to set the stage. It was 60 pages of legislation. There's
Correct.
obviously a lot more out there through the model rules, commentary, and now through the administrative guidance. What broadly was in, what broadly was out? What are we going to see potentially from enforcement orders that you had mentioned earlier?
Sure. So the focus is around chapters 1 and 2. Scope and also charging provisions, and then Chapter 5, the computation of the ETR and the top-up tax. Again, who are the taxpayers, how much tax needs to be paid, that was important, so that was in the legislation. As to Chapters 3 and 4 around global income or loss or adjusted covered taxes, that will be issued in the enforcement orders.
Okay. And what about there's a whole number of other chapters too, like transition rules is something that has been the focus of a number of taxpayers for transactions that occurred after these rules were initially proposed in November of 2021. Will those other sections be incorporated as well?
Enforcement orders, yeah, I think.
Okay.
Yeah.
All right. And then you had mentioned the safe harbors, and so
Exactly.
the safe harbors were those actually included in the legislation?
Legislation as the temporary safe harbors will be in. And this will be quite important as well. We can talk about that later in terms of how, the extent to which safe harbors might apply is critical, given that Japanese tax functions are relatively thin in terms of resources. But again, the number of entities that we might need to consider is quite significant.
Yeah, and one can imagine, given for the reasons that you had already articulated, and we'll dive into that a number of the Japanese multinationals, those 800 in-scope companies, will want to take advantage of the transitional safe harbors. But I will remind listeners that it is a transitional safe harbor.
Understood.
So the work is still there. We'll see if we end up getting permanent safe harbors, but. We'll certainly see. So what about effective dates? Because I think Japan maybe threw the globe a little bit of a curveball that we don't have an effective date of January 1st. It's April 1st, or tax years beginning after April 1st, 2024?
That's correct, and that's an important point, Doug. So the Japan IIR will apply for fiscal years on or beginning April 1st, 2024. And this is designed to align with the fiscal years of the vast majority of Japanese multinationals, whose also start in April 1. At the same time, we do have a handful of calendar year taxpayers to which the Japan IIR will only apply in 2025. And as you might expect, they have to deal with questions around, well, will the IIR or their foreign subsidiaries apply, or perhaps UTPR to the extent it's introduced in 2024 and certain other jurisdictions could apply. So they have a kind of separate set of questions. But by and large, the April 1st is designed to align with
Interesting. So for example, U.S. multinationals or non-Japanese parented groups that maybe have acquired a Japanese parented group and have subsidiaries underneath Japan, I think that may be the more common fact pattern where you would see a January 1st deadline, and so they'll get a 8-month reprieve on the IIR because they have
the Japan
calendar,
IIR. That's correct.
Because they have the calendar year.
Yeah.
All right, now you had mentioned the qualified domestic minimum top-up tax,
Yes.
and that was not included in the legislation.
Correct.
Potentially, I assume both the QDMTT and the UTPR would have similar effective dates, so April 2025 as opposed to January 1st. Is that kind of typically
that's right.
how?
That would be the expectation.
And so, the QDMTT, one of the things that we've seen that I think has been a surprise to a number of us advisors is that despite the fact, or just generally under the Pillar 2 rules, one of the things that's been a surprise is that jurisdictions that have an effective rate above 15%, so in the U.S. is a classic example of a 21%, then you add the state rate, that as a result of domestic incentives, whether that's the R&D credit or FDII or frankly other book tax differences, that it's pushing multinationals' Pillar 2 calculations below the 15%.
Yes.
And so we mentioned the QDMTT in Japan. How relevant is that for Japanese multinationals? Are there incentives kind of similar to what we're seeing in the U.S.? I probably should have also mentioned some of the incentives in the Inflation Reduction Act and some of the green energy credits, but are there similar type of incentives in Japan that could push Japanese multinationals below the 15%, that could put them in a QDMTT position?
Sure. So we do have two things. One is as you've mentioned, the R&D credit in the U.S., I've seen Japanese multinationals who take R&D credits in the U.S., and so they may be subject to the Japan IIR.
And it's
in that respect.
non-refundable?
Correct.
Okay.
And well, that's the U.S. side. Japan side, same thing.
Okay.
Similar to R&D credit in the U.S., non-refundable. But it's the magnitude of the credit is such that we should not see the rate go below 15%.
Okay,
yeah.
But obviously you got to do the modeling. But it just
you have
sounds
to do the
like
modeling,
the
and there are
R&D
other incentives. So I mean, theoretically, it's not impossible. Yeah,
okay.
Yeah.
And so we received some guidance in December that you're well aware of with respect to the Globe Information Return.
Sure.
And I think one of my takeaways from the Globe Information Return, I did a podcast with Michael Leckie
Yes,
on this, where
yes,
we reviewed, it was more kind of a list of data points than really kind of the tax return that I think many taxpayers and advisors were hoping for. Do you have any thoughts on what Japan is thinking about with respect to the forms and the compliance and how that fits in with the Globe Information Return?
Sure. We actually worked with taxpayers on an OECD public comment to the OECD for the Global Information Return, so I'm quite familiar with some of the concerns that the taxpayers have.
Yeah, there was a lot of comments.
Yeah, so let's.
By the way, it was amazing. It was great how advisors, taxpayers, I think there was something like 90 comments on the Globe Information.
Exactly, on the OECD homepage
Yeah.
website. These concerns are real, and so they were raised. I mean, there's a number that were raised. I mean, one is, should the returns be filed in the local country, or can we file all the returns to the UPE jurisdiction? Others included, and this is something that has been a consistent concern over the past year or two, is the concern around the information that's submitted, and can that be, per the information exchange between jurisdictions, be used for purposes other than Pillar 2, such as perhaps tax audits. That is another concern that Japanese companies have. And also just the kind of unification, or if you will, the simplification of forms in terms of, can we use can we incorporate the CBCR into the Global Information Return, et cetera? We have so many forms that is there any way to kind of align those? It's another kind of a compliance-driven concern that Japanese taxpayers had.
So really, no information at this point from the Japanese government or policymakers, but you and Japanese taxpayers are still engaging with the OECD.
Correct.
And I'm guessing they'll kind of follow the OECD's lead if they even provide significant guidance on what those forms should look like.
To be continued.
To be continued. And the point on information sharing and how various taxing authorities could potentially view is a real concern. And
yes.
I think what some policymakers have said, well, we already have country by country reporting that provides insight. That does not create anywhere near the level of detail.
Correct.
And frankly, even beyond the ability for taxing authorities, just the information that many taxpayers have that would be included within there, whether that gives away certain kind of trade secrets, or is a real concern for taxpayers.
Yeah.
So let's move now kind of below Japan. So as we think about the Japanese IR and how Japan may tax under Pillar 2 constituent entities or non-Japanese foreign subsidiaries below Japan. Before we dive into that, wanted to just get a refresher here, because I've talked to you many times over the years on the Japan CFC rules.
Sure.
Can you provide a brief overview of how the Japan CFC's rules work? Because you have a pretty stringent CFC regime, frankly, arguably more analogous to the U.S. Subpart F regime than and GILTI regime than other countries that I've worked with.
Yeah, I mean, Japan's CFC regime is quite robust, and so this is the interplay between the CFC regime and Pillar 2 is quite critical, and we can discuss that later. But first, the Japan CFC regime, it takes an entity-based approach. So unlike perhaps Subpart F, where you're looking at particular types of income, we look at the entity itself.
Okay.
And so, is the CFC does it satisfy certain tests? We look at ETR, effective tax rates, and also economic activities. And there's different thresholds, like are you under or above 20%, are you under 30%, et cetera, and then do you have economic activity? And for example, if your ETR is less than 20% and you lack economic activity, then the pickup is the full income, entity-based. So that's significant when you think about it's not just passive income, but full income. In other instances, it might be passive income. So depending on which bucket you end up in, you could be at full or passive, but yeah.
And how does, you mentioned effective tax rate, how is that computed? Is that
it's on tax
Japanese taxable incomes?
For Japanese tax purposes, and this comes up, just a quick digression, Doug, but for example, in post-merger integration, where for local tax purposes it may be tax-free, but for Japanese tax purposes it would be a taxable transaction. So when that happens, you have limited or no local tax, but it's a taxable transaction. And so for Japanese tax purposes, the ETR ends up being low, and so therefore there could be a full income pickup. And
Got it.
So there's that tension around. We have to consider for Japanese tax purposes, whether it be for local tax purposes, if you're using a participation exemption or some type of tax-free reorganization.
And the U.S., for example,
for Japan doesn't respect, let's say like a triangular merger or something like that, then that would end up being a taxable transaction for us. So that is quite important, and we have many discussions with our counterparts all over the world on this point.
So you really have to layer in sort of the view of the Japanese tax rules and system to the CFCs.
Yes,
and so, but what also that I think tells me, Shin, is that the tax base from a Pillar 2 perspective, based on book income with all the adjustments, could be significantly different than how the CFC regime works.
Yeah, so there's another set of calculations that will need to be done. Now, certain taxpayers said, can we somehow merge the two? And it's not, technically may or may not be possible, but setting that aside, I just want to make one important point. The CFC rules apply to all companies, whereas Pillar 2 applies to only in-scope companies. So as a fundamental matter, we can't quite merge the two rules because you can't drag the CFC regime into Pillar 2.
Right, so for those less than 750 million euro top line.
Yeah.
Makes sense. Now what about, and I'm going to nerd out here a little bit from a U.S. tax perspective, but just kind of comparing the U.S. CFC regime and the Japan CFC regime. What about foreign tax credits? I assume there's a foreign tax credit regime that works. And
correct.
How does that operate?
Yeah,
you get kind of full credits.
You get credit for that. Yep.
You get credit for the foreign taxes that you paid to reduce your U.S. tax liability. And I assume that Japan does not have any of the kind of crazy expense apportionment rules that we have that require certain expenses that are sit at the parent company to be allocated.
I'll leave that up to you guys.
I'll let up to the U.S. folks.
Through,
there's a lot of history there, but so that doesn't exist in Japan. Okay, so I think it's going to be an interesting kind of layover for low tax entities or for Japanese constituent entities that are operating low tax jurisdictions like Ireland, for example, Hungary, just any really of the countries that may be below 15%. It sounds like the Japan CFC net may be even broader because it's a 20 and 30% effective tax rate threshold, but given those base differences, you're obviously going to need to do the modeling. Now, what about to the extent that jurisdictions start to implement QDMTTs around the world?
Sure.
Any thoughts about whether that may be creditable from a Japanese perspective, and how might that fit in if we do start seeing jurisdictions implement a QDMTT starting in 2024?
Sure. So I think that prior to the administrative guidance, Japanese companies thought, well, we'll pick up the CFC income at the Japan parent, then be taxed in Japan, then push down the CFC tax and take that as a credit against QDMTT. But now, per the administrative guidance, we understand that QDMTT takes precedence over CFC taxes.
Right.
So I think what we're going to see is, regardless of QDMTT, there's going to be, if the Japanese CFC rules apply, there's going to be a CFC income pickup. So I think it's similar to U.S. and GILTI, perhaps to the extent it will be applicable in the future. The question will be, will QDMTT be creditable in Japan, or otherwise there could be a double taxation issue. Assuming that the QDMTT is similar tax base to the IIR, then I think there's a reasonable basis to view that as creditable. I mean, to be further discussed in Japan. But
yeah, it's interesting. So the Japan multinationals have the same concern and issues because of the robust CFC regime, similar to the U.S. that. Because the QDMTT takes precedence and that those CFC taxes are not credible, there is a significant risk of double tax. And then it'll be interesting to see how the QDMTT, once it's assessed, how that then fits within the CFC regimes of the parent company.
Yeah, that's going to be critical per the administrative guidance.
Now, what about if the Japanese parent company is in a loss, like if there's a domestic loss for Japanese purposes, but there's still CFC income?
Sure.
How does that work, and what are some of the potential issues from a Pillar 2 perspective?
Sure. That's an area that we've been struggling with. If the Japan parent has a loss and there has CFC income pickup, then the CFC income will be offset by the NOL. So essentially, in that case, there will not be any Japan cash tax that arises. So therefore, no cash tax to push down to the CFCs. Now, I guess in the case of a QDMT post-administrative guidance, it's not as critical since the QDMTT will already be applied to the local jurisdiction. But still, in the case that if Japan IIR comes into effect in 2024, and perhaps certain jurisdictions don't implement QDMTT until 2025 or onwards, then you still have a question of, in that instance, the Japan IIR could potentially pick up CFC income that it otherwise is already using to offset NOLs, so that could in some ways be viewed as a double taxation.
I mean, the complexity is mind-numbing.
There's tension here.
Absolutely, and I think the challenge that taxpayers are going to have is, I think that, there's kind of the conventional wisdom is that most jurisdictions that are implementing the Pillar 2 rules will implement the QDMTT.
Sure.
But there's going to be this timing issue, right, as far as what jurisdictions actually implement the QDMTT, when do they do it, and kind of layering this on, and then now we've got Japan with the April, and just has different jurisdictions, in Korea, which has said UTPR and IR 1124, and then how this layers in with respect to foreign tax credits, particularly we have CFC regimes, will be very challenging for taxpayers just from a pure calculation perspective.
And Japanese taxpayers have raised this issue with the OECD with no guidance at the moment. But again, there will be, again, to your point, there will be certain taxpayers in certain situations that happen to have a loss in 2024, et cetera, that will have the impact. So there could be somewhat skewed, or it's somewhat disparate. So it may not warrant a wholesale address from a legal perspective. So we are speaking with certain taxpayers that are in those types of situations, for sure.
So since we've kind of moved to complexity, let's maybe move on to what I've been referring to, operational readiness. So I've been talking to taxpayers around the globe, and the big a number of challenges with respect to Pillar 2, and one of the big challenges, just operational readiness. Are the right stakeholders involved to be able to set up this whole new set of books? Right, and there's tax accounting issues, and then accounting issues. There's systems issues, and we've done some analysis. We think about 60% of the information that you need can be found in ERP systems. The other can be found in a myriad of different locations, some of which may not exist depending on how intercompany transactions are accounted for. And then, of course, in addition to the operational readiness, there's the data readiness. But you had mentioned earlier in the podcast that frankly, Japan multinationals tax departments may be smaller, generally speaking, or smaller than what you've seen as a U.S. advisor and in the U.S. So how are you seeing Japanese multinationals start to get ready for this? And I assume that, that now that we're kind of in early 2023 here, that there's starting to be a much bigger focus on Pillar 2.
For sure, and as I mentioned earlier, it was widely expected that the IIR would be introduced as part of the 2023 tax reform. So beginning in the fall, Japanese multinationals have begun to already gather the data, and of course with the tax reform proposals and draft legislation, it is certainly picking up. And based on the work that we've been doing with Japanese companies across the board, we're in the same situation that U.S., European, Asian multinationals are in terms of data gathering, the difficulty, the challenges of locating reliable data from readily available sources, for sure. And then you have issues around financial statements, is it deferred, for example, reliable, et cetera. But also, I think that in the case of Japan, and where of course we're dealing with different accounting systems, consolidations, et cetera, and all that. But in the case of Japanese companies, also with respect to the tax function, generally operate relatively autonomously, the foreign subsidiaries. Now, we do have information gathering processes in place for CBCR or Japanese CFC.
Sure.
So there are channels of communication around data already in place. But again, going back to something you mentioned earlier, Pillar 2 is the whole nother level. And the other point is that Japanese companies have been quite acquisitive recently, and so the tax functions have not perhaps been integrated. And so you're again, even within tax,
Sure.
you are communicating with various stakeholders in the company. Not to mention that, as you all know, when we talk to the tax guy, it's usually an accounting question, et cetera. So we have all that as well. So I think that going back to the tax function, really going to be a question of how can we implement a framework to how do we assess the data, and we need to work. Technology will be critical, of course, but the interaction, the collaboration between companies and advisors will be incredibly critical, as given the enormity of the task. And for example, how do you apply safe harbor exclusions, et cetera, systematically?
Right.
There's just so many that, in a way, that think about how do you want to approach this directionally, then go into the data and then make decisions. So lots of interaction, in a way, qualitative and quantitatively, that perhaps we've not seen in the past.
Yeah, I think that is a common message that I'm hearing, and you know, one of the examples that you gave was a Japanese company recently did an acquisition.
Sure.
You know, whether the tax functions are integrated. Well, there's oftentimes the systems haven't been integrated yet either.
Exactly.
And so it's not uncommon for multinationals to have varying ERP systems, even though all the information doesn't need to be there. And so that really
Correct.
seems to be a common theme amongst Japanese multinationals, U.S. multinationals, and other Japanese multinationals. So. I think that the message is for Japanese multinationals, is anybody operating in Japan, or if you have Japan subsidiaries, regardless of where the parent company is that the time is to start. April 2024 may sound like a ways away. Maybe for calendar year taxpayers, they've got a little extra time, but obviously other jurisdictions are already going to be implementing effective 1/1/24.
Correct. Yeah,
so it's important to start
underway.
to start to get that infrastructure put in place. And the technology point that you mentioned is interesting, because it seems to be that there is a trend now where people understand the enormous complexity associated with these calculations, trying to figure out a way how to get out of a spreadsheet environment where the enormous complexity that we discussed with respect to the ordering rules and the push down of taxes will make operating in a spreadsheet environment very challenging. So it'll be interesting to see how Japanese multinationals, as well as other multinationals, look to technology to help inform both the calculation as well as the data process. So maybe here, just kind of at the end, shifting away from Pillar 2, as hard as that is for me, as much as you know I like to drone on about Pillar 2, maybe talk a little bit about the Japanese deal market, and maybe what are you seeing for both like a Japanese inbound as well as a Japanese outbound? Any trends here in 2023 that, as you kind of look in your crystal ball, what are you seeing from a Japanese deal perspective?
Sure. No, I mean, the deal market is robust. First of all, from the outbound perspective, Japanese companies need to expand overseas, and not only to grow, but to transform their business. And we've seen that over the past couple of years. Now, during COVID, there was some temperament because companies couldn't go overseas for due diligence, et cetera. And then we have the weak yen, which has had its challenges as well. But again, for example, if you look at the U.S., stable deal environment, the IP technology that we can only get here in Japan, so in the U.S. Sorry. So when I talk to senior management, when I talk to others, there is sustained and strong interest in continuing to invest in the U.S. Not to mention, Doug, that Japan is #1 in foreign direct investment into the U.S.
Right.
So for the past couple of years, so that's continued. There are again currency fluctuations that we have to deal with that do impact the market. But when you talk to management, they're saying that they need to act, and that hasn't changed.
So what about from a Japanese inbound perspective?
Inbound perspective, interestingly, so you have the large Japanese conglomerates, and again, when you look at the past couple of years, they have been trending towards selling off their non-core businesses, so in various industries, and in many cases, these are being sold to foreign buyers, for example, private equity funds, and again, Now, in this case, you have the weak yen, you have low borrowing costs in Japan, so there is quite a bit of interest in making acquisitions inbound into Japan.
Yeah, it's an interesting point because the interest rate environment in Japan is significantly different than, frankly, what we're seeing in the U.S. and Europe and other parts of the world.
That's right. No, it remains a rather matter of national concern, but it is quite low, and so borrowing costs continue to be favorable.
So maybe the last question then is kind of shifting gears again.
Sure.
To I like to ask the non-U.S. folks that come on trends in tax controversy. Because
Sure.
I think one of the things that we're seeing, particularly in a post-COVID world, that a lot more interest and scrutiny from taxing authorities on taxpayers. Is that consistent in Japan, or any trends that you're seeing from a controversy perspective?
Sure, I would say so. When as COVID set in, we had fewer numbers of audits, naturally. But again, the revenue was relatively stable, and this owes in part to a more targeted approach that the tax authority are taking. They have a little more time to review the CBCR, additional information, and then they will take a targeted approach in looking at different industries or different issues that may be of particular concern to them. Also, because of COVID, and now that we live in a digital world, for example, we've seen cases where VPs of tax have been asked to join tax audit meetings with the authorities online. And that didn't happen before. And so from a tax authority perspective, they just want to understand the bigger picture. So it's not with particular intentions in mind, but again, it enables the authorities and as well as taxpayers to have a more candid discussion around the big picture business and what led up to the tax controversy. So something to keep in mind going forward for our multinationals as well.
All right, well, Shin, an interesting window into the Japan Pillar 2 rules and the overall international tax environment. Thank you very much for coming on the Cross-Border Tax Talks.
Yeah, thanks for having me.
I did want to
Doug.
also tell you how much I enjoyed my trip to Japan, and the partners and the team there were a pleasure to work with, and we were able to film a number of episodes
Yes,
from a Japanese
exactly.
perspective, so it's great to have you on the Cross-Border Tax Talks.
Thanks so much, Doug. Really appreciate it.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Shin Yamaguchi, PwC's international tax partner and leader of PwC's Japan inbound tax practice. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.